Welcome everyone. My name is Kamal Manocha. I represent PMS AIF World. We are back with another webinar on Friday evening. We have been viewing stock market over last many years, and over last 3 years we saw one very significant change that happened, whereby stocks that we were calling as compounding businesses like Asian Paints, Pidilite, and likewise they actually have kind of taken a pause and they are seeing time correction. And at the same time, many stocks, many businesses from certain sectors which were actually underperforming have actually taken the lead. There have been stocks from real estate sector, many PSU stocks, infrastructure companies which have been rising. Over a time, we have been kind of to an extent maybe ignoring this change because we have been learning that quality generally in long term delivers compounding. But is this change a long term change or not? This is very, very significant question. But to understand the perspective of this change, we have kept this webinar with Mr. Abhisar Jain, who basically has done a very deep research in this aspect, and he's trying to correlate this to a change in terms of the source of money. The money which was coming to stock market erstwhile was more of FII money, but now we have seen more of a DII money over the last 2.5 years, because FIIs have been kind of taking money away. In fact, of late over last almost 1.5 years, FIs have been net sellers because US bond yields have been rising and there has been flight of capital from equity to debt. So we will understand from Abhisar Jain today in this webinar that how the increasing DII flows are actually changing the dynamics of Indian equity markets and what does this convey for medium to long term future. It's very, very interesting topic and I myself want to understand. Let me spend 1 minute to introduce Abhisar Jain. Abhisar Jain is head and fund manager at Monarch AIF, and Abhisar did his MBA from SP Jain College and then is also CFA, brings with him 15 years of experience. Under his leadership, this Monarch AIF over time, over last 4 years, since 2019, has been able to garner around 300 crores of assets. So, Abhisar actually is a pertinent fund manager in terms of kind of delivering robust returns, because we have studied the performance also of Monarch AIF. You may not have heard much about Monarch AIF because these are some of those boutique AIFs, boutique products which actually directly deal with some of the large family offices and do really well. On the other side, there could be a lot of products which talk a lot, but actually their performance is moderate. But here, we try and get perspectives from those fund managers who are actually delivering alpha, and hence numbers speak more than words. So over to you, Abhisar, for this webinar. Let's first understand your perspective on the entire theme which I have discussed, which is actually very interesting, and followed by which I'm also keen to understand the offerings that Monarch AIF has and what is the philosophy behind that. We'll deep dive that further in the second half of this webinar. In the first half, let's understand the perspective on how consistently rising DII flows are changing the dynamics of Indian equity markets. Over to you.
Yeah, thank you, Kamal, for a kind introduction, and thanks a lot to PMS AIF World for hosting this webinar in partnership with Monarch AIF. So, Kamal, before I dive into the presentation, I want to make this point that having watched the Indian equity markets for quite some time, and I believe you will also, and our viewers also will agree with me, that erstwhile, historically, when we used to see the DII inflows behavior, it used to be a little bit, coming with a lag, wherein DIIs were, say, behind the curve in terms of both buying and selling decisions. Maybe they were the last ones to sell, and also the last ones to buy, which used to create this impression that effectively the DIIs were more like followers and were effectively not having the full grip on the market or driving the market in turn. Having said that, what we kind of saw in the recent years, and that's what kind of intrigued our interest, where we kind of deep dived into this study and in fact published a detailed investor newsletter also, because at Monarch AIF, as you mentioned, we work very, very closely in terms of the market trends as well as on our stocks, and we publish quarterly investor newsletters. We have done 10 of them now. So latest one was on this, where we deep dived into exactly what is happening behind the scenes, what is driving, and what could that be having its implications on the market. So before I begin, I thought I'll maybe put this in perspective, because this is what I had also been viewing in last 15-20 years when DIIs used to be a little bit in terms of the followers, but now we feel that DIIs are the leaders. In fact they're mature enough to even absorb all the selling force from the other investors. So with that, Kamal, let's deep dive into our presentation. If you can just put it up. So effectively, we in this webinar today, I plan to talk about the DII flows coming of age. Okay, and to begin with, I'll just maybe quickly take my audience through our agenda for today. We'll first cover on the topic where we want to talk in detail about how the consistently growing DII flows may be changing the dynamics of the Indian markets itself. We will focus on 5 to 6 key points here, and I'll go in detail. Then I would take some time to talk about our investment strategy and our track record. We are now around 3 to 4 year old AIF firm, and we have done 2 strategies only till now. So that we'll talk, and then of course how we are different versus our peers. I would like to talk about that, but first part will be focused on the topic in hand, which is the DII flows. So as I mentioned, the DII flows in our view have come of age, and the consistently growing flows have an impact on the market dynamics. So let's first look at exactly what has happened here. If you look at this chart, okay, then you will see one very clear trend, which is that DII flows now have been consistently growing in amounts, okay, and they have been scaling up. So like if you see in the last 10 years, there has been only one single year when the DII flow on a net basis has been negative. And if you see also in the last 10 years, there have been now many years when the flows on an absolute basis is more than 1 lakh crore. So like in FY18, we were at 114, then we were 129, then 221, 256 in the last 2 years. And this year also, FY24 year to date, we are like more like 7 months, 8 months into the year, we have already crossed 85,000 crore. So this has been a remarkable shift. Actually, if you go back a decade prior, say FY5 to 15, then you will find many years where the DII flows would have been negative. Maybe 5 to 6 years out of those 10 years, the net basis flows of the DIIs would have been negative in a single year, even though many years between that 5 to 15 years were also good years. Like 3 to 7 was a very consistently fast moving market, whereas in the last 10 years, even when the market has been little sideways or things have not been always great, the DII flows consistently have been positive and also have been growing in magnitude. So this is one of the key trends, and the blue bar is the MF net inflow and the green bar is the DII net inflow. As you know, DII net inflow includes the MF as well as the other categories within the domestic institutional investors. Now, why is this happening? Okay, and what is leading to this DII flow being very consistent and also growing? So what we saw in our analysis is that the non-cyclicality of the monthly SIP flows, okay, this is something which has been phenomenal and has led to this. Many of you are also noticing this, I'm very sure, and coming across this data, but just look at the magnitude in the first chart that we are showing here. So just 7 years back, in FY17, the monthly SIP flow which used to come in Indian markets was only 3,500 crore. I have averaged out the monthly flows for each single year here in this chart. Okay, so from 3,500 crore, we have now scaled to 15,000 crore almost on a monthly basis. Last month was all-time high again at 16,000 crore. But the important point to note here is that this has been immune to even Six Sigma events. So I want to give you an example here. Means obviously the live, the fact-based data. So in FY17, when demon happened and we were running at around 3,500 crore monthly SIP flow, the SIP flows even in demon didn't fall. They just flattened out for some time, 3-5 months. And then by FY18 itself, they reached 5,500 crore kind of run rate. Then they kept on scaling to around 8,000 crore run rate, and then COVID hit, right? As we all know, in FY 2021. At that time also, it flattened out for some time. This time it flattened off for like say 8 to 10 months at around 8,000 crore. And then even before the COVID could completely go away, by the time the COVID was ending, we were around 10,000 crore in FY22. And from then on, we have, been scaling almost one way, and now we are at 15,000 crore. So the monthly SIP flows have grown 4x in 7 years. This is quite phenomenal. Basically, what is happening is that across the households in India, people are taking, big time to regular investing methods, and they're not maybe looking for only short-term gains or one-time investments. They're going in for the long haul. And when we look deeper, when we tried to look under the hood, we also found that it's not just the top 30 cities, but beyond 30 cities also. As you can see in the rightmost part, the second table here that we have given, the bottom 30 cities, the beyond 30 cities have also been giving a decent AUM to SIP, is almost like 2.3 lakh crore now. And the total SIP AUM itself is 8.6 lakh crore, which used to be only 2.7 lakh crore in FY19. So only in 4 to 5 years, the SIP AUM itself is nearing to be more than 3.5 times. So the point to take away here is that these are the non-cyclical flows. They are nearing almost $2 billion on a monthly basis now, and they have penetrated deep and wide. So that's where the sustainability should be better. And see, at the end of the day, the SIP flows are now comprising of the majority of the MF flows. And as we saw in the previous chart, if MF flows are substantial, then the DII flows are also substantial, because MF flows form a very big portion, almost like 70 to 80%, 80%, 85% of the flows of DIIs are comprised of the MF flows. And MF flows in turn are driven by SIP. So the equation is quite simple here. If you have a gross higher SIP flows, then you will have higher net MF flows, and then you will have a higher net DII flows with low volatility, because SIP in turn itself has been very less volatile even in Six Sigma events. So that's the key point to note here. This is another, very interesting chart. In fact, we ourselves were very surprised when we kind of collated that data. And when we spoke on this data to many of our investors and even our peers, including some of the fund managers on the MF side, they were also very surprised. So if you now look at on a cumulative basis, actually now the DII flows on a cumulative basis are higher than FII flows on not only just this calendar year, which is CY23, they are higher than FII flows on a 3-year basis. They are higher than FII flows on a 5-year basis, and they are higher than FII flows on a 10-year basis. This I'm talking cumulative basis. Whereas in the earlier decade, they used to be only 20% of FII flows. Can you believe this? That, from only 20% of FII flows on a cumulative basis, now the DII flows on last 3-year basis have been 3x. So we are like $64 billion in terms of the DII flows from CY20 to CY23, whereas FII has been only 22. We are 3x of them. Same way on 5-year basis, CY18 to 23, we are 86 and they are 32. We are 2.5 times. On a 10-year basis, we are 15 billion more than them. On this calendar year basis, as you all know, we are running at close to $20 billion and they have put in only $12 billion. So effectively, the resilience of DII flows, which is backed by the sustainable and non-cyclical SIP trend, that is making our markets to be less dependent on FI flow. Whereas erstwhile in the previous decade, and mind you, 10 years back, SIP as a concept itself was just starting out. So I showed you in the previous slide that the SIP flow itself in FY17 was 3,500 crore per month. If you go 5 years back further, say to FY12, it would be just like 1,000 crore, or before that even non-existent. So that is why the DII flow at that time used to be a fraction of FII flows. Now, since you have so much of wall of money coming from the SIP itself, which is non-cyclical, our DII flows are much higher than the FII flows. So we have edged the FIIs out, and maybe it's the Atmanirbhar era, which we call it, now for our market in terms of the flows. Within the FII itself, it is very interesting to note that, like, okay, we may be higher than them, right? But does it mean that FII flows are not important for us? Not at all. And does it mean that the FIIs are ignoring the Indian markets? Not at all. Just see this graph. The FIIs have continued to favor Indian market in the last 10 years continuously. So this is the 10-year data across the emerging markets. I have listed down some 8 emerging markets here: India, Indonesia, Philippines. As you can see, on a 10-year cumulative basis, FIIs have still got around $65 billion here, right? And they have been net sellers in many of the markets. Even in Brazil market, they have been net buyers. It's just 1/3 of the flows that they have got in India. So actually, from a FII perspective, the Indian market is providing a lot of attractive characteristics. We are now the 5th largest market cap. We have more than 400 stocks which are above $1 billion market cap. We have more than 100 stocks which are above 5 billion market cap. And we are providing them diversity with quality. We have many subsectors. We have many sectors. We have very high private ownership, by the way. So all these characteristics, continue to make India as a attractive market for the FIIs, no matter what. Now, because of these flows, of the DII flows being high and FIIs also preferring India on an overall basis, what is actually happening is there are many second order impacts which are playing through in the market in our view, and we try to figure out some data around this. So one thing which we clearly saw was that the institutional holding, which we call as FII plus DII, in all the stocks which are above 5,000 crore in India, this is the first chart, where the FII plus DII holding has gone up already in last 10-12 years from 19% to 25%. And what this has done is that this has basically reduced your float down to around 19%, as you can see in the first chart. Interestingly, the promoters have not given too much of a liquidity. In India, as you would appreciate, a lot of promoters feel very good about their businesses from a long-term perspective, as India is still a growing market. Our GDP over the next 6-7 years will still double from this, or maybe in the next 2 decades, it will take a much bigger leap. So promoters have continued to hold on. In all the greater than 5,000 crore market cap companies, the promoter stakes has just come down from 58% to 56%. Okay, what does that mean is that effectively the other free float is getting squeezed, and your institutional holding has gone up and promoter holding has remained stable. And because of the less liquidity available in the market, because the promoters are not selling and institutions are building their stakes, there have also been a very good rapid expansion in the valuation multiples in our view, at least for the good fundamental companies. So this is what I've shown here is the valuation expansion for all the companies which are above 5,000 crore market cap and which have 5-year average ROE greater than 15%. So the PE is expanded from 22 to almost like 39 times. This is as of June end. And even EV/EBITDA has expanded from 14 to 22 for this set of companies, which have a ROE above 15%, 5-year average, and a market cap above 5,000 crore. So this is the second order impact that we see which is happening. Now, because of all this, we believe that there are certain investing implications which the investors should keep in mind. Okay, and we have obviously discussed them in greater detail in our detailed investor newsletter. But what we feel is that if this trend kind of continues, where the SIP keeps on building further and the DII flows continue to remain strong, and FIs also kind of view Indian markets positively because of its strong fundamentals, then there would be something has to give, right? Because the wall of money will keep coming. So the free float creation may be required through higher promoter stake sales and obviously much higher quantity of new IPOs. Also, what this will do is that there will be opening of new subsectors within the larger sectors. And we are seeing this, already happen. Like you all have seen in the healthcare sector, we have now a diagnostic subsector which has come up with new listings coming in the last 5 years. In the hospitals, there were earlier only 1 or 2 hospitals listed. Now you have almost, I think, some 8-9 hospitals listed. You have a new subsectors which have been created by asset management companies getting listed within the BFSI. You have now wealth managers listed within the whole asset management, fund management, wealth management sectors. So I think this will continue to keep going on even further. You have now electronic EMS sector listed. 3 years back, there were hardly any EMS companies listed. So this will keep happening. Also, the companies which keep showing strong execution and have solid governance standards, they may see quicker re-rating because of the kind of inflows and the money which is waiting in the wings. And the valuations of quality franchisees, they need not be very big companies like the Asian Paints or the Page Industries or the Titans of the world, but even the quality franchisees in the smaller market cap, which is anything between $1 to $5 billion, they could kind of re-rate and sustain at higher levels for longer because there is no incentive for all these institutional holders to sell in a hurry, particularly with the inflows sustaining. And Indian market direction largely could also be driven by DII flows going ahead and not be over dependent on FII selling or buying, in our view. So these are the kind of investing implications that we see, which our study has been throwing based on the analysis that we kind of took. Now I will maybe take a pause and discuss on this topic a little bit more when we go into the Q&A. But I would like to take you all through at Monarch AIF what exactly we have been doing in the last 3 to 4 years, what is our investment strategy, and a little bit on our track record. So see, Monarch AIF is part of our listed parent, which is Monarch Net Worth Capital. It's a listed entity on both the stock exchanges with 1,500 crore market cap. And our company is into various financial services, which includes investment banking, equity research, retail broking, and asset management is run under AIF. In AIF, we basically run very focused and concentrated strategies where we take only less than 20 stocks, and we are the stock selection is very disciplined, as I will discuss. We are also recognized in the industry for writing bold quarterly newsletters. As I mentioned, we've written 10 of them. Some of you may recall around 1.5, 2 years back, we had written on super quality stocks, valuations being very, very high. And those newsletters, were appreciated in the market for being different, for being bold at that time. We also have certain differentiating factors versus industry. We have very low fixed fees. We have competitive performance fee. And we generally, have been kind of managing money by raising it directly without any intermediaries. So in terms of the strategy, very quickly of how we go about selecting our stocks, one thing that we want is that we generally look at and buy stocks only where we have a long track record. So we don't get excited with new companies or companies with very limited track record, which just got listed, or it's a new age tech model, because we don't have history to do our analysis and make a very strong call on the business. So first we draw a focus list where we need very strong track record and good corporate governance history. We have a proprietary AQCG scoring method also to judge the corporate governance. Then once we have some focus list, we look for these 3-4 characteristics that I have listed down on the right hand side. And first of which is that we need the compounding to be visible in the cash flow statement. Actually, we believe that the P&L statement and the growth which the company show in P&L is more like breaking news item, but the real thing gets hidden in the cash flow statement. We need the OCF CAGR over P&L CAGR, and we need a high level of conversion from EBITDA to OCF. On the return ratios also, we have a slightly different method. We don't filter for very high ROE, ROCs companies, because very high ROE, ROC companies would be known in the market, would have been re-rated in the market. What we look for is that the companies which have respectable ROE, ROC, but incrementally they're generating higher ROC. So we look for superior incremental ROC. What I mean by incremental ROC is that now when the company is putting 100 rupees in the business in the last year or last 2 years, they have started to make higher ROC than their 10-year average. So if they make 10-12% on a 10-year average, now when they put 100 rupees, they're making 15, they're making 20. This may be happening because of various reasons. Either their brownfield expansion is low cost, either they've got some now pricing power, or they have cut the cost, there's some efficiencies, economies of scales, could be numerous factors. We go and study that. And lastly, on the balance sheet, we want that the growth which the company is displaying, how is it funded? Is it funded? If it is generating the OCF, like in my first point, then it will be funded internally itself. They don't have to go to external capital providers like the banks or the equity holders for dilution. So we basically want that companies, we are not averse to that. We are not averse to dilution completely, but we want companies who are able to fund a lot of their growth from the internal accruals itself. And last, of course, is the valuation, which is more art than science. You don't have strict filters there that say 30, 40p is costly and 10p is cheap. But what we try and do is we employ various methods. We look at EV to cash flow. We look at discounted cash flows. We look at free cash flows. We look at PE. We look at EV EBITDA. Look at companies' own history and its comparable peers to the within that subsector, and then try to take a call. But at the same time, we are very cautious on not overpaying for quality. So something which beautifully fits my filter, will I go and pay anything and kind of feel that I will still make a 15-20% CAGR? No, that's not what we feel. So this is how we do it. We like take only 20 stocks in our funds based on this very strict filter. And then we kind of basically manage them well. We don't churn too much. Our churn rate is well below 20%. And our filtering in the stock selection is very stringent. So as I said, we have done 2 funds only till now, one of which we have even returned the capital. This was our maiden fund, which was raised in October 2020, but we pre-closed this fund in May 2023 after generating 23.5% CAGR, and we returned 100% of this capital in May 2023. So 100 rupee, which we took, we returned around 169. This is our second fund, which is live and running, which we started in August 2022. This was a 250 crore AUM, which is right now 330 crore. We are generating around 20% on a CAGR basis versus the Nifty 500, which is our benchmark at around 10% CAGR. Some of our stock picks in the first 2 funds, this is quite interesting versus what I had mentioned as the key things. So in the maiden fund, Polycab, JBChem, these were one of the few of the stocks that we had taken, which were beautifully kind of fitting in our filter of cash flow generation, incremental ROC improving, valuations at entry not being too costly. In fact, JB Pharma we are owning in our current fund also. And in our current fund, some of the stocks that we have been owning are Syngene International, Brigade, Cyient, which we took in January at around 900. We still own it. And IFGL Refractories in a small consumable space. So most of the stocks that you see here, we have been owning for more than 1 year and we still own. It's not as if something has gone up 50%, 70% and we have kind of churned out and taken something else. We have almost nothing in our fund from either the defense space or the railway space, mainly because there's been working capital has been very, very high. The cash flows have not been so much in compounding. So we have not even had those kind of stocks which have maybe done phenomenally well in this leg. But since the other stocks, which were very carefully picked, have been doing well and we have been able to ride them for long without the need for churn, you could see the performance playing out. So, and lastly, just to end this discussion in terms of actually the question which I keep getting asked by most of my investors are, how are you different? Everybody says that they also select their stocks well. We can see the returns also of many of the funds also being good. So how are you different? How do you add value? So what we say is that, look, what we're trying to do is that we give a structure which is having fully aligned interest with our investors. And one thing which we do different versus the competition in our view is that we don't raise money all the time. We raise it only once in 15 to 18 months. And then we close the fund. And we have a flexi cap fund structure. We're benchmarked to NSE 500, but we buy between 20 to 25 stocks at max. We keep low fixed fee. We have no entry load, no exit loads. And of course, being an AIF, we are mandated by SEBI to have our own skin in the game. So our USP is that we are very focused. We don't keep raising the money all the time. So the fund manager bandwidth is available to do the fund management, to kind of manage the stocks well. We are not too much, into the limelight or into the media trying to market ourselves and be all the time visible, because we don't feel the need for it. We want to put 70-80% of our bandwidth into real fund management by keeping the cost low. And then those low costs also add to our returns for our investors. So versus the other PMS AIF, I think we do have a competitive offering in that aspect. Yeah, that's about it, Kamal. I think I'm done from my end and open to questions now.
Sure, Abhisar. I think this was a very insightful presentation. A lot of good data has been shared, and I see, as you are presenting, the audience number kept increasing because obviously, people like to hear new stuff, and your webinar absolutely was talking about something different and new which people have not heard about. Just give me 1 minute. I'll just stop the slideshow. So we have understood your insights on the DII flows increasing and that conveying something different happening in equity markets. But broadly speaking, at this juncture, if I was to ask you, for your fund that you're raising, which is like a multi-cap fund, there are stocks like which are like stocks which were liked by FIIs a lot, which could be, I would say, coming from IT sector, coming from financial services sector. We may not want to take names, but still, for learning purpose, not for any advisory purpose. If I was to talk about something like HDFC Bank, TCS, right? So in upcoming AIF for which you're raising money at this current juncture, what are your views, in this regards in terms of large cap side of market? Because yours is a multi-cap AIF, right? And we have been giving a perspective that FIIs, are kind of not investing, DIIs are investing, and DIIs are more value conscious. There is more value in small and mid cap space. We are raising money, you are raising money for your multi-cap fund. Definitely the foremost question which any client would want to ask is, what percentage will you be investing in large caps, and what type of large caps, and what, how will you select large caps?
Sure. So Kamal, as a strategy, what we do in our flexi cap funds is that the large cap portion is between 25 to 35%. But more importantly, the large cap portion is concentrated in our funds only from the sectors. Okay, 1 or 2 sectors, which at that point are kind of ignored or anti-consensus, and where the last 1 year, 2 year returns have been very, very poor, but the fundamentals are not as such poor. Okay. So what we do is, on the large caps, generally we feel and believe that they will be largely fully valued, to the extent that they might be able to give you only market returns or sometimes even less than market returns. And that is why, Kamal, that's the precise reason that 80-85% of large cap funds ultimately fail to beat even the large cap index, right? Okay. And that's why ETFs are becoming so popular, because generally in the large caps the information gap is very little. The analytical gap on the understanding of the markets at large and the fund managers at large is also very little. But what we have seen, if you look at the last 20 years, and you will appreciate this, that 1 or 2 large cap sectors get ignored at different points of time. Sometimes auto is very ignored, like some 2.5, 3 years back, or maybe 2 years back. Most of the auto stocks you were getting at almost like, very attractive valuation. Because at that time, some industry fundamental of auto was against, so sab kuch hi, was down. Sometimes it's IT out of favor, sometimes it's banking out of favor, sometimes it's pharma very out of favor. At that time, what happens is that within that sector, you can get a good blue chip stock, okay, which fits your criteria, and your IRR will not be sacrificed, whereas the downside will be very limited. Only thing which you will not get is, you will not know the timing of when it will perform well, okay? And the whole market in large caps wants to time it to just 1 to 2 quarters in advance. When the whole thing will reverse, I will enter that time. What we try and do, Kamal, is that we take a 8 to 10 quarter view in the ignored large cap sectors or something which is out of favor. So suppose at this point of time, if there are certain large caps in the chemical space, specialty chemical space, which are out of favor because of some genuine reasons, because of the overcapacity, inventory buildup, China issue, etc., then we will go and study and will not take a 2 quarter view. We also know that nothing may happen in the next 2 quarters. But I'll try and build my model and my thesis from an 8 to 10 quarter perspective. Same way on, say, an HDFC bank, okay, within the banking space. So now might be possible that the whole banking space is not anti-consensus at this point of time, okay? But within the banking, the valuations are comfortable, as we all know. And within that, the valuations may be very attractive in 1 or 2 PSUs and, say, an HDFC, because HDFC was going through a merger, HDFC was going through a transition, and people want to kind of wait out of how the merged entity will emerge, and at that 18-20 lakh crore of base, how will this elephant grow, right? So what I'm trying to tell you is that we have this 25 to 35% large caps. At this point of time, we are viewing some of these stocks within the banking favorably. We are viewing some of these large cap stocks within the chemical space favorably. Whereas most of the other large caps, if you talk about even the IT sector or the consumer sector or the pharma sector, we believe that some of those there the valuations are nowhere near to be very attractive or anti-consensus of that sort. So this is how we do in the large caps, and therein we are then not worried that whether the re-rating will be driven by FII flows or the DII flows, Kamal. Even the DII flow magnitude now is so high that flow itself can also move the large caps whenever they go there. So yeah, this is how I see it.
So maybe a brief answer. So which means at any point of time, your portfolio within large cap will have maybe one or two sectors, not beyond that.
Yes, that's right.
Sure. What is the total number of stocks that you are eyeing to kind of add in the portfolio, and how do you decide allocations, weights, to respective stocks?
So Kamal, we have been very disciplined to do less than 20 stocks in both of our funds that we have done till now. And the first fund was more like 100 crore. The second fund is like 300 crore. Now what we are raising is between 500 to 600 crore bare minimum. Okay, so in the 500 to 600 crore, we still want to stick to max like 20-22 stocks. And within that 20-22 stocks, as I mentioned, between 5 to 6 stocks could be the large cap stocks from one or two sectors. The remaining are the 14 to 15 stocks below $5 billion market cap. So below $5 billion or something like 40,000 crore, we consider everything as mid and small. The weights that we do in each of the stock at the starting level itself, from an entry perspective, we take 4 to 6% as the range. So we don't take very small bets of 1 to 2%. We believe that if you're buying 1 to 2% only, we are not fully convinced on the story. So we want to have each position at entry between 4 to 6%. If something compounds and grows its weights in the portfolio, then that can be an automatic thing wherein its weight may go to 8%, 10%, and somebody else's weight may come down to 2%, 3%, something which is not working or which is not performing. But at the entry, it's between 4 to 6%, and large caps are between 25 to 35% from one or two sectors which are ignored at that point of time, and limited to 5 to 6 stocks in large caps and 14 to 15 stocks in the mid and small caps.
That at the moment there are certain geopolitical risks. We have elections, going to happen over next 1 year, and you're currently raising money. How are you going to construct your portfolio? How much cash levels are you going to hold? Because this is a very common question which everybody wants to ask. Everybody tries and wants to time the market always, but at this juncture there are certain reasons for investors to actually time the market, because we know next year is an election year. Markets are at all-time high. Though valuations wise markets are decently attractive, earnings are fine, but still, what is the fund manager's answer to this question?
Yeah, sure. So see, Kamal, one thing which we have learned over time, okay, is that market always climbs the wall of worry, and then it ultimately starts to go, keeps going up over a long-term basis. That is the first thing. The second thing, actually, if you see at the Nifty index level, while at this point of time, all the talk is getting concentrated about the huge rally that we are seeing in the mid and small caps, and no denying that some of the valuations in the mid and small caps are going to little non-reasonable levels, at which you may have very large drawdowns in some of the stocks in those areas. But if you were to come back to the Nifty 50 or the Nifty index, which is at say 19,800 today. So as you may recall, the previous high for Nifty 50 was in October 2021, which was 18,600, right? At which time, actually, the earnings were yet to come, but the index had scaled up to 18,600 and the P's were touching more like 24, 25. In the meantime, at least post-COVID, the earnings played out better than everybody's expectation. I think, Kamal, you will know, having tracking this very closely, that last 6 months or 12 months were the first time when the Bloomberg consensus estimate for the EPS was going up and not getting downgraded further. Hamesha, otherwise the Bloomberg consensus will start at a certain level. By the end of the year, it would be down 15-20% from the earlier level, or from the 1 year back level. So effectively, you have had the EPS story play out. You have had the reforms further taking place, like the PLI reform starting to come, the digitalization story of India further deepening, the GST collections going up, the infra story overall panning in the right direction. May not be everything hunky-dory, but going in the right direction. EPS is coming, slowly and steadily. You have already crossed around 820, 830 EPS this year. You are supposed to be 900 plus, and next year 1000 plus. Okay, or approx in this range. And your index is only 1,1300 points higher than the 2-year back level. So at 19,800, you are effectively coming 1 year forward at around 18 to 19 times. Now, given our fundamentals, Kamal, and given the kind of consistent money which is now coming, because the household penetration, which was erstwhile only at 5%, these guys have decided that, okay, if not lump sum, I have to do consistent monthly investing, which you guys are also propagating, right, all the time. And a lot of MFDs are also propagating now all the time. So with that, it gives me very little reason to believe that, you know, even if there are some geopolitical events out there, or some other ball of worry, what will take it down to 16, 17p or 15p for me to enter at a much attractive level? That is, you know, the key question I'm also thinking when we are kind of going to investors. In fact, what we feel is that if when this inflation trend kind of sustains at a lower level, like you saw the recent print, and immediately the bond yields kind of, you know, came down, and in the markets globally also reacted, you may have less things to worry next year. Okay, then the only thing to worry will be, of course, some big war between one or two countries on the geopolitical level, but at least the inflation problem would have come down. And from an Indian perspective, the fundamentals are taking their own good shape. Political angle also, it seems highly improbable that, you know, some other coalition can win big. If they do, then of course we have to reassess. We have to obviously see what are the impacts. At this point of time, Kamal, to be very frank with you, we feel good about raising the money at around 18, 19 times, earnings having gone up and the Nifty index having not gone up. At the same time, we'll be very cautious when we are constructing our portfolio. We'll take after even the money comes, we'll take our sweet time, 2-3 months, and we'll be cautious on the mid and small cap where the valuations have gone up suddenly very high, right? Within the mid and small cap, as you also know, there'll be pockets where there is value, there'll be pockets where there's euphoria. And as a fund manager, that's our job, to not go in euphoria. And plus, it's a flexi cap fund, so we will be able to pick decent amount of stocks from the large caps where right now there is a little bit better value, right? So this is the way Kamal will go about it.
So there have been, certain interesting questions in the chat box.
Yes.
Let's maybe take a couple of them.
Yes.
One of the questions is that why is there no consumer discretionary financial services and banks or power stocks? I think, you should clarify this aspect.
No, it's not as if he's talking, I can see this question maybe coming from Archit. If he's asking that whether we do have or don't have these in our portfolio, we do have. In fact, even in my current portfolio, we own 2 banks, which is ICICI Bank and SBI. We are also owning consumer stocks. We have Blue Star in our portfolio, which we have been owning from last September. We have not sold anything there. It has been a very good compounder. We don't own power stocks currently in our portfolio, mainly because, as I said, that the stringent filters that we have been employing, we generally want confirmation of our portfolio stocks to the extent of 80 to 90% of those filters. So I need the cash flow compounding. I need a decent level of ROC, which on incremental basis is improving. Sometimes in very capital intensive sectors or which are going through a transitionary phase, like say the power stocks, we will not have, certain of our filters which are clearing. And in that case, we are okay to even miss some of the rally in those sectors if it doesn't conform to our strategy. But we own consumer discretionary, we own financial services, we own banks. So that I can clarify that much.
For sure. So if we're talking about AIF here, and then AIF has a minimum ticket size of 1 crore. And in this particular AIF, the 1 crore is, going to be invested in one go. Obviously, yes. It is the discretion of the fund manager to, invest in various sectors and hold certain portion in cash. But from investor's point of view, 1 crore has to be given in one go. Yes. And then, the question to you, Abhisar, is that after you invest, how the communication is shared with the investor? What is the frequency? And will the underlying portfolio holdings, allocations, the logic and the overall, I would say, communication, newsletters, in terms of what is expected out of the portfolio? What is the frequency of that, and how have you been doing in the past?
Yeah, sure. So, Kamal, the frequency is that we have a fund fact sheet which keeps going out on a monthly basis, which will give a lot of details about the fund and our holdings. We also have the quarterly investor newsletter which goes out, and we do quarterly webinars also with our investors. Apart from that, our lines are always open and free for our investors to call us and discuss with us on either of the portfolio holdings or anything else about the market. So since we are very boutique, we have limited number of investors, we are very focused, and we are not raising new money always. We are always available for our existing investors. So while we have this communication from our end on a quarterly basis and a monthly fact sheet going, but on any query which the investors have on either the portfolio or markets in general, we are always available. But as such, on a quarterly frequency, anyways, there's an interaction which happens.
Sure. How is performance fees calculated in your fund? Is it calculated and deducted every year, or at the time of maturity, or at the time of redemption? What is the frequency and how is it calculated?
So see, we effectively work on a model which is low on fixed fee and largely driven on performance fee. And at the same time, we also don't hold our investors to be with us by keeping ladder-based exit loads or very long lock-ins. So what we do then is that we have very limited lock-in, Kamal, of around 18 months. And hence after that, any investor can go if at all they want to book profit, or if at all they're even not happy with us and they want to go. So as such, on a performance fee basis, we have a yearly mechanism wherein we apply the high watermark, and our hurdle rate is 10%. Over and above the 10% on the excess returns, we charge 15% performance fee. And of course, the high watermark applies and there is no catch-up. Now this fee, because we don't have lock-ins and we allow the exits, these keep getting charged on a yearly basis. And that's how we work.
Sure. At the moment, in your multi-cap AIF, you said that you want to invest around 25-30% in large caps.
Yes.
And, remaining in small and mid caps.
Yes.
So can this change over time during the life of the fund? Is it a flexi cap kind of a structure, or it will remain same?
So it is flexi cap, and our benchmark is NSE 500. Okay. But given our size, Kamal, and given the mandate that we are going to with our investors, we feel that there will not be much of a reason to increase the large cap much beyond 35 to 40%. Okay. So there is a slight flexibility that we get. The guided range is 25 to 35. At max, I may go 1 or 2, 3 percentage points over and above that. And my mid and small caps, mind you, is everything below $5 billion market cap, which is like 45,000 crore and below. So not necessarily that in small and mid, we are going to very small stocks. In fact, Kal, I want to tell you that we have very few stocks which are, maybe say only 3 or 4 stocks which are below 10,000 crore or 5,000 crore market cap. We have many stocks between 5 to 40,000 crore market cap. And that is the space also where we are seeing that good companies which are executing very well are doubling, tripling in value, even within 3 years, 2 years, 4 years. So it's not as if, that if you want to generate alpha, you need to go very, very small only. Of course, you will have higher chance if you find something good in very small also. You can make 3, 4, 5 bagger also. But we have understood that we need companies which have long track record, which have good execution power, which have now decent level of runway between 5 to 10 years. And that's where more and more institutional investors will get attracted, and they can, compound even when their market caps are 10,000, 20,000, 30,000 crore. So below 45,000 crore, so we are able to get a lot of companies per se across market scenarios, and hence there's no need to have a much higher proportion of large caps in my view, because see, as I said, in large caps, generally you will not find so much of opportunity to create that alpha, so much mispricings. You will get it in 1 or 2 sectors at given point of time when they are for some genuine reasons ignored. Okay, and that's where you will get some blue chips at some bargain, but not across the way. If I have TCS also, Reliance also, HDFC also, and Asian Paints also, I don't think so I can make the CAGR, and there will be information asymmetry and valuation gap on all of them. So that's what we keep in mind always as such.
Sure, Abhisar. This is the closed-ended fund, right?
It's a closed-ended fund. Yes. So we raise money and we close the money can't come in that scheme again as such. Only the redemptions can happen after the 18 month of lock-in or once we kind of wind up the fund. But new money doesn't come in, so it's a closed-ended, and we also do raise in largely one shot, either one closing or second closing max. Otherwise, we have always been doing only single one and final closing as of now.
Sure, perfect. So I'll just repeat for the audience. It's a category 3 AIF in listed space with 1 crore as a minimum ticket size, has to be invested in one go. First 18 months is the hard lock-in, and followed by which one can exit as and when required with no exit loads. Otherwise, total tenure of the fund is around 3 to 4 years.
Yes,
and
4+2. Yes.
4+2, right? So 4+2 years, and the intent is to return money, in 4+2 years. So Abhisar, you have very, I would say, interestingly answered the large cap side of the portfolio, that how you will pick and how alpha can be expected on large cap side of the portfolio. On the mid and small cap side of the portfolio, I want you to cover how much will be put into mid caps, how much into small caps, because you mentioned you take it as collectively, companies below 40,000 crores of market cap. Now, this is a very large universe of companies less than 40,000 crores of market cap, and there are many sectors, many companies which are actually at very higher levels, and valuations are also high. How will you avoid not getting trapped by greed, or how will you kind of avoid this, not making mistakes? And then how will you ultimately discover those businesses which maybe you will be early investor, or you will see through pure lens of deep value? Because as you said that you want to balance between value and growth. You do not want to overpay. At the same time, you do not want to just look at value. Now, in large cap space, we understood the logic. But in the mid and small cap space, I want you to spend 5 minutes and explain it. How will you actually execute?
Sure. So yeah, Kamal, see, as the mid and small caps have continuously been rallying now for, I think, good number of months, maybe 6 months, 7 months, and it has been extremely strong rally. I think even in November, I was just seeing yesterday that the small cap index itself is up maybe 9%, 8-9%. So see, definitely it is becoming challenging, to buy good stocks in the small and mid cap space at the right valuation. I must admit that it is becoming challenging. At the same time, Kamal, see, one thing is that at the process level, in terms of the identification of the stocks, we make no compromises that those 4 to 5 key filters that I have, they should clear. Like, I should be able to see cash flow compounding happening. I should be able to see a business which has some kind of leadership trait in either its product services or its cost, and the incremental ROC is improving and the growth is being funded by the internal cash flows. Now, on the valuation aspect, Kamal, thankfully what is happening is that the market itself, the depth itself is broadening a lot. And let me just give you a little bit of an example here to be able to make you understand that, like, how we think and how then we are able to narrow down in terms of the right stocks within the small and mid cap, even if the environment is challenging and valuations is high, like the case it is now. So how we do it is, look, Kamal, if like 12-13 years back, I told you that, look, we have done the analysis and we are positive on the real estate cycle. Looks like real estate cycles are very long, 7-8 year cycle rahega, and I want to bet something on the real estate. 12-13 years back, if you had to bet on a real estate cycle, you will have to go and buy the real estate listed developer only, maybe a DLF or a Unitech. You will have had very little options to do anything else. Today, if you want to play the real estate cycle, there are 5 more subsectors which are listed. There are wood panel mein 6 companies listed, whereas Century Ply is now a 10,000 crore plus market cap with decent amount of cash flows. You have plastic pipes listed, where Astral has been such a big multi-bagger, but there are now 3 to 4 more plastic pipes. You have tiles listed, ceramics and tiles listed. You have even a mattress player listed like a Sleepwell. Same way, let's even see a big sector like BFSI. So 15 years back, mostly only banks were listed. Even within the NBFC, there were maybe 2 only, HDFC Limited and Bajaj Finance. Today, Kamal, you have wealth managers listed, you have asset managers listed, you have MFIs listed, and across these subsectors, you have 5, 5, 6, 6 guys listed. Within healthcare, you generally used to have only formulations listed. Today you have diagnostic companies listed. Today you have hospitals listed. Now you have even CDMO players listed. So because of this diversity, Kamal, what is happening is that then, we have calculated within our team, there are around 70 subsectors. If you look at in pharma, we have 6 subsectors which we track: diagnostic, hospital, domestic branded generics, formulations, and CDMO. Same way in BFSI, like 7-8 sector which I mentioned. Now, out of these 70 subsectors, in one or the other subsector, I will be having some, valuation dislocation, wherein for some reason, maybe the valuation is not that high. Like in diagnostics, there were concerns around, the price erosion. So while the whole pharma might be trading very, very good, but you may have value in diagnostic, you may have value in hospital. Same way, even in IT, you will have a lot of subsectors. In building material, you will have subsectors. So what we do, Kamal, is that first, we don't compromise on our filters. And secondly, for the valuations, we try to look under the hood. Okay. We try to look at long-term trends with thesis from a 5-year, 10-year perspective in an India-like market is good. Okay. But the valuation in one specific subsector is not too bad. It is still okay, even if the whole small cap, mid cap index is very high. Having said that, because if your small cap index itself has rallied 40% in 6 months, 7 months, you will have maybe majority of the portions trading at high valuation, no denying the fact, and you'll have to be extra careful. We are still able to find opportunities, Kamal, and that's why being concentrated helps us. We have to find only 14 to 15 opportunities. I don't have to build a portfolio of 50, 60 stocks where I'm buying very costly stuff also. I am buying attractive stuff also. I can, pick and choose my stuff from the 70 subsectors, maybe 10, 12 subsectors I'll get. Like say, let me give you an example. Into the consumer related stuff. Okay. Some of the consumer electricals have been struggling now for quite some time. Okay. Be it the Cromptons of the world, be it the Orient Electrics of the world, be it the Havels of the world. They have been going through very painful time correction. Even, you have some consumer segments which are going very, very high. Like the luggage and all, it is going. Consumer lifestyle, entertainment, discretionary is going. Okay, but some segments you will always find that there's some struggle happening. QSR is struggling a little bit. I'm not saying I'm having any QSR stock or I'm having these FMEG stocks in the portfolio. All we own within the consumer durables and electrical space is Blue Star. But I'm just telling you that, look, there will be some value somewhere in some of these subsectors. So that's how we do. And filters, which we have identified, that we kind of take care of them very, very strongly to avoid the mistakes. Because as you stressed on that point, that how will you avoid the mistakes? So once we have that selection criteria clearly defined, then we avoid the mistakes.
Understood. Well put. And last, I want you to explain about your sponsor, Monarch. Obviously this is a listed entity, I know, but it is important for you also to explain the background and the overall, group.
Yes, sure. So, Kamal, thanks a lot for that question. So, see, Monarch Group is a 35-year-old group and listed on both the stock exchanges. This company, we are a completely, well-diversified financial services firm. Through this 35-year history, majority of our history of like first 20, 25, 30 years have been only into retail broking. But now in the last 5 to 7 years, with the arrival of a professional management, which included me also coming on board 5 years back, along with a group of 10 to 15 more people and the new CEO, Mr. Gaurav Bhandari, who joined, we have diversified into being the capital market related businesses across investment banking, across institutional broking, across asset management, which is AIF. In terms of our promoter background, our promoters are two entrepreneur brothers, Mr. Himanshu Shah and Vaibhav Shah, who are based out of Ahmedabad, Gujarat. And they have been enjoying very, very close relationship with a lot of big corporate groups, mainly out of Ahmedabad and Gujarat. So groups like Ratnamani, Symphony, Alembic, Adani, and many, many more. We have our promoters enjoying 4 decade-old relationships with them. Ourselves, the professionals who came on board like 5 years back, we were working together in Centrum earlier for more like 10 years together. And then we came here as a entrepreneurial, semi-entrepreneurial role with skin in the game to set up these businesses which were not erstwhile present in Monarch and to set them up properly. So now, of course, from a promoter-driven entity 5 years back, it's a professional-driven entity. The CEO reports to the promoters, and we all are heading our division. Like I am heading the AIF division. Similarly, we have a head for the investment banking. We have the head for the IB. And this year, H1 FY24, Kamal, we have done 54 crores of PAT as a group. All of our businesses are fully owned by our listed entity, Kamal. There is no cross holdings of the promoters owning something directly. AIF is fully owned, banking is fully owned, investment banking. So we have done 54 crore of PAT in H1. And yes, we traded around 1500 crore market cap. This profitability 5-6 years back used to be on an annual basis between 10 to 15 crore at max. And now we have been scaling up as we got the market tailwinds, of course, but we've kind of set up the businesses which are now contributing meaningfully. So this is a little bit about my sponsor. Monarch Net Worth is the sponsor for the AIF, where they put more than the regulatory requirement of SEBI into my AIFs. They generally put more than that. We have the sponsor and the promoter family interest between 5 to 7% in each of our schemes.
For sure, Abhisar. I think this is quite an interesting discussion, starting from very insightful understanding of how the change in flows have a role which is important to be studied for the upcoming, expected future of the kind of dynamics in equity markets. And then the product that you discussed, the process that you shared. Absolutely, everything has been very, I think, vividly discussed. Thank you so much for your time today. And thank you everyone for joining us. Such webinars kind of, remind us that yes, investments is a business, is a profession, is the overall, I would say, area of passion, which can be kind of managed well if we passionately keep learning, keep understanding, and keep the faith. With these thoughts, I will just like you to wish good luck, Abhisar, for this fund, as well as
thank you.
Goodbye to all of you. Thank you so much for joining.
Thanks a lot, Kamal, once again for inviting us to do this webinar. Thank you everyone for attending and listening to us. Thanks.